which always remain as highlights, or as we call the superstars. It's very attractive in the financial market because of the features that it offers to the investors. Okay, as you say here, literally the verbal meaning. In fact, that is a plus point with respect to derivative instruments. Some of the instruments really reflect what they are. As you know, some of our names carry some meaning, right? Likewise, here in this case also, they have some, these words have some verbal meaning. Option, as the name indicates, it gives a right to the option holder to exercise or not to exercise the particular transaction. Okay, option gives the right to the holder. Okay, a holder for exercising or not to exercise, withdraw from exercising his right. So the obligation part, which was there with futures, is taken out. But it's not at free of cost. It's just at the payment of some amount, which we call as option premium. Right? So the word carries a meaning. The meaning is the option holder is given with the right. Okay, he can decide upon whether to go with or not. So that's the option available. If I want, I will go. If I don't want, yes, I'm not going to. Maybe I'm going to lose some money which I've paid as my premium. But still, it is better than me incurring a huge loss. So that is the attractiveness of option as a derivative instrument. With this note, in our today's class, we are going to discuss about options, and in this 1 hour time, we would be covering options and types of options, the primary features, the terminologies commonly used in option contract, as well as the difference between futures and options. Okay, so we'll start slowly. As I said at the beginning, option is a derivative instrument where its value is derived from the value of the underlying asset. And option gives the right to the holder to exercise or not to exercise a particular contract. See here, I have put an example of an option contract, which is with respect to call option. It's for purchase of shares of Hindustan Unilever, which is maybe when they were entering into the contract, the spot price of HUL is 2,350 per share, and they've agreed for 3-month period. The contract, the tenure is for 3 months. The holder is having the right to purchase the share at 2,350 with the stipulated time. Now, we can imagine, suppose if I am promised, if I have the right to purchase a particular asset, I always will be looking at the movement of its price. So in this 3-month period, either the asset price can increase or the asset price can come down. These are the two possibilities within this 3-month period. Right. Now, the person who has given me the right for some benefit, that is called as premium, which we are going to discuss at a later stage, is expecting that definitely the price is not going to, as you say, the price is not going to increase. He is expecting that the price is going to decrease. So if the price decrease, this particular person who has bought the right from him, say we will name that person as Mr. A. Mr. A, who has bought the right from him, will not exercise it. So the benefit for him is he can sell if he is not exercising it, then the person who sold the right is with the benefit of premium money, as well as he can sell the asset. The contract is cancelled without exercising after 3 months. So after that he can sell the asset in the market. So he gets the premium as well as the asset. So that's what the expectation of the person who do not have right, who has sold his right to this particular person, right to sell. So this person took the position of that person is called as short position. The position of the person who buys the right is called as long position. Now this can be for purchase or it can be for selling. You can purchase the right either for buying or for selling. When you say that it is for purchase, long position and call option. That is, you bought the right, right? You bought the right to purchase the asset at a stipulated price, which means it is long position, okay, and it is call option. You bought the right to sell the asset at a particular price, which means it is long position put option. So this is the background. Okay, so in both the cases, when you buy a right, it is called as long position. When you sell a right, it is called as short position. So in this particular case, this person will exercise his right only when the share price of HUL is increased or has increased above 2,350 within the final date. He will exercise his right. If not, he is not going to generally, because he will just look up what is the premium he has paid for, and he will see what is the decrease in price. He will check up, and if the price has decreased, suppose if the right is for purchasing the asset as 2,350, but in market the same asset is available at 1,900. Definitely that person will not exercise his right of buying HUL share at 2,350. Why? In spot at that time, the same asset is available at 1,900. So that is the relevance of option contract. If you want, if you are in a long position, you have the right to decide whether to exercise or not. And this is the charm of an option contract. Okay, this is the charm of an option contract. So we are moving further. Now, these are some of the terminologies which we often come across when we are dealing with options. Now, as the first one, index option, as the name indicates, the underlying asset in this case would be Nifty or Sensex or any other index like as such Bantex as it is. So that is why we say that the underlying asset is an indication looking at the name of that option. So the next is stock option, where we can understand that in this case, the underlying asset is a stock. Say, for example, the example which I showed you, it was an example of stock option, where the underlying asset was the share of Hindustan Unilever. So that is an example of stock option. Now the third one is buyer of an option. Otherwise, a person in the long position is supposed to buy the right to purchase the asset at a particular price. So if you want to exercise, he will. If not, it is not mandatory. It's not obligatory, which is pretty different from the futures. It is not obligatory on his part to exercise the option. So that's why we say that he's supposed to be in a long position. And now the next one, what we are going to discuss is the other party, the writer of an option. In this case, the person who is selling his right to the buyer who is in long position is called the writer of an option. Now, why does he sell his right? He is getting some premium amount from the buyer of the right as a reward for selling the right. Okay, so that is something which can be the only benefit sometimes. If the buyer exercises the deal, if the share price increases, maybe we entered in at 2,350, but it was a bullish market. Their share price of HUL went up to 3,000. This person, the writer of the option, is in unlimited loss. He will get only that premium amount, because he sold his right. When the price of HUL is 3,000, this buyer will exercise the option of possessing HUL at 2,350. That was the contract. So that is actually the position when you are selling you have a chance of unlimited loss. You don't know. Possibility of maximum profit is the premium. The premium, even if you know, even if the contract is exercised or not, even if it is not exercised, the premium amount is already there with you. But such a person will enter into this contract only when he is expecting a bearish market. Otherwise, he could have sold that asset directly in the market at 3,000. Since he expected that, sometimes this expectation may go wrong. Since he expected that the market is going to go down, it's a bearish market. He wanted to protect himself from the fluctuation in the price. He entered into this contract. He was ready to sell his right for the premium. So he is called as the writer of an option. Now the next thing is call option. Now when we are talking from the perspective of call option, it talks about the right. It talks about the right to buy a asset. And put option, it talks about the right to sell a asset. You can decide whether you're going to. Now, selling, in case of selling, it's just the opposite. You are actually buying into a put option, expecting that the share prices sometimes can go up. You want to sell your asset at 2,350. It's a reverse concept, okay? You want to sell your asset at 2,350. But if you find that the asset price has gone up to 3,000, then you can decide that you're not going to exit. If you have that right with you, if you are in long position put option. If you've sold off your right, you cannot. That is a person who is having the right to exercise an option is in a comfortable zone, whether with respect to call option or with respect to put option. Put is for selling, call is for buying. But in both the cases, when you buy the right, you are in long position. You can buy the right for buying, you can buy the right for selling. If you are selling the right, you are in short position. Right? So that is something which you really have to understand as we move further. Okay? Now, there are a few more terminologies which you really have to understand. Option premium. Option premium, I already mentioned about that. That is the premium which is paid by the person who is purchasing the right to exercise an option from another party. Say if A is in long position, B has sold his right to maybe his right to purchase an asset, or he has sold it to A. In that case, A in return for this will be paying B a premium for selling this right. Okay, A now can decide whether he will buy it or not, on looking at the price that is prevailing in the market. So the amount paid by A to B for selling his right to him is called as option premium. So now A is in long position after paying premium to B. So B is in short position. He sold off his right. So that is what we call as option premium that I showed you when we were really in, looking at the NSE platform. I had showed you the premium amount, the strike price, all that. Then expiration date is nothing but the valid period. In our previous example, it is 3 months. At the end of 3 months, then we said that for NSE, it's always the last Thursday of the month. Most of their contracts, almost all their contracts are set up like that. If it is 1 month, at the end of the at the end of this month, the last Thursday of this month, provided it's not a public holiday. Then if it is 3 months, the last Thursday after 3 months. So that's the maturity date. Strike price, that's the price specified in the contract at the time of entry, based on the underlying asset. Say I said, when you are operating through a stock exchange, you have something called a slot size, right? So depending on that, your strike price will be decided. But the primary thing would be decided upon the value, the spot price. Maybe the spot price is say 2,220. So you say that yes, after 3 months you are willing to sell your asset at 2,330. Depends upon the parties, it can vary. Okay, and the strike prices, at what price you have decided to sell. Maybe if the lot size is 100 shares of HUL, that's your strike price. Okay, then American option and European option. In case of American option, you can settle on any date. But in case of European option in India, most of it is with respect to European option, but with individual stocks, American option is also available, where you can exit on any date after settlement looking at the price movement. But index, the other types of securities, the exit from the market can happen only on maturity, which is called as European option. So American option is you can settle on any day during the period of the contract. But in case of European option, you can settle only at the end of the maturity date. So most of it in Indian market, except stock, goes with European option. But in fact, that is less confusing because the market is continuously changing. Calculation of margin, calculation of the actual settlement payoff, all these would be difficult if you are trying to exit maybe before the maturity date. So, but it gives more liquidity to the investors. You need not wait for 3 months to exit the market if you want to. So that's a plus point of American option. Now listen to me very, very carefully. This is the logic which we use in option pricing. The 3 terms that needs to be very thorough with you, that is in the money, at the money, out of the money. Okay, these are the 3 terms that we have to know very clearly if we have to go with the understanding option pricing. Okay, in the money is a case where we are talking about a positive cash flow when we compare between the strike price and the spot price. Say for example, if you have agreed to sell an asset, okay, in our previous example, this is if a contract is to purchase 100 shares of HUL at 2,350, you are actually set to be in the price when the price of HUL is above 2,350. Why? In that case, you can easily make profit. If it is above 2,000, say if it is 2,450, automatically what happens here is you can buy the asset at 2,350 and sell immediately the asset as 2,450, because that's the price trading in the market. You can make a profit of 100 rupees. That is what it happens when it is with respect to the call. Okay, that is if you can make profit out of that transaction, that is you were promised to be sold, with the other party has promised to sell you HUL shares, 100 shares at 2,350. Even though in the actual there can be cash settlement, only the difference might be paid by, if the person who was agreed to buy is Mr. A, sell is Mr. B, we will only set off the differences. But actually, if it's the case of 2050 and the share price, the spot price on future date, on the settlement date is 2,450, it means that Mr. A is able to purchase 100 shares of HUL at 2,350 per share, which is actually trading in the market at 2,450. He's getting an asset which is valued more at a lesser price. So he's making profit. If he want, immediately he can sell that asset in the market at 2,450 and gain a profit of 100 per share for 100 shares. That's the charm of derivative market. So such a condition in call option is called as in the money. In put option also this will happen. In put option, how does that happen? If you have bought the right to sell an asset, okay, at 2,350, and you find that the market price is 2,250, you are in the market. Actually, the price trading in the market is 2,250, but you can sell your asset at 2,350 based on the right you had got through your option. So you have 100 rupees gain, and that gain will be transferred to you by the person in the short position. Excuse me. So this will happen in case of put option if you have bought the right to sell the asset. So such a condition is what we call as in the money. You have a profit margin, whether that is with respect to buying or selling, you have a profit option. Now we are going to do exercise on this. Okay, I will show you exercise in that. Then you will understand that in a better way. I have put an example also. So listen to me. The theory part should be clear. Then I'll show you practical exercise also. At the money. At the money is, it's saying you have agreed to purchase that. You have the right to purchase at 2,350. Price prevailing in the market is also 2,350. Zero, no cash, no. Maybe if you have paid a premium, yes, I'm coming to that. You have to adjust that also. Suppose you have made a premium, it should be a situation where everything is taken care. Because when you buy your right, you have to pay the premium. Suppose if you have paid a premium of 50 rupees, that should be added with your cost, and then your cost and your actual position in the market and the spot price in the market is same. No inflow or outflow, that is said to be at the money. There is no inflow, there is no positive gain or negative gain. Negative, or as you say, loss. You are in a par position. Your cost is equal to your possible revenue, your possible gain. So that is a case of at the money. Out of the money is a condition where, as I said, you can purchase. Your right is purchase HUL share at 2,350, but currently the HUL share is trading at 2,000. Who will exercise the sometimes you might, okay, because you expect that the market is going to be very bullish in next 6 months. You might exercise that, but looking into what premium you have paid, you will make a comparison between all that sometime, but normally it is out of the money. But as speculators say, out of the money options are a little cheaper. The premium for them will be a little cheaper, and that is why sometimes people will go with buying that, expecting that in future that can go up. But generally, what does it mean? If you have the right to purchase an asset at 2,350, and if the asset is trading at a lower price, 2,000 in the market, there is no cash flow for you. You are in fact incurring a loss. You could have bought that asset at 2,000 from the market, and the right for you is to buy that same asset at 2,350. You may not exercise that if you are not speculative enough in the market. You may not buy that. Right. So such a condition that can happen for selling also. Suppose the market, you have the right to sell an asset at 2,350, but actually in the market it is trading at 2,600. It's out of the money. Why? Why should I sell my asset at 2,350 when in the market I can sell that? That is future spot market. I can spell, when the date of expiry, I can sell the same asset at 2,600. There also there is actually a negative cash outflow, inflow. So what I do is I will not exercise in most of the cases. Such a condition is what we call as out of the money. We are going to explain, we are going to do exercise in this. This is called as out of the money. Okay. Now, since we are going to do an exercise, I'm just moving forward. Now, there are a few more which you have to understand before we go with solving a problem. The intrinsic value of an option. Intrinsic value of an option is the actual value of the option at the given time. At what price? Say, for example, the intrinsic value is I can purchase HUL share in the month of July for 2,350. So that is the intrinsic value, 2,350. Now there is another term called time value. Here we know that when we are in a long position, definitely we have paid something called as premium at the beginning, right? Otherwise we cannot buy a right to sell an asset or buy a right to buy an asset. We cannot get that. If we really have to get that, we have to pay a premium at the beginning. So actually that is a cost for us. Even though we say that the intrinsic value is 2,350, I had paid some amount at the beginning to get this right. Right. So the difference between the intrinsic value and the premium is what we call as time value. That is, say, for example, for getting the right of purchase of HUL share at 2,350, I have paid 50 rupees as premium. Then naturally it will be 2,350 minus 50, which gives me time value. Which gives me time value of that particular contract. Right? So it's nothing but intrinsic value minus the premium. Okay. Now, option also, most of it we are discussing about regular standardized market, but there are options which are traded as customized transaction between the parties over the counter. So that is why there are exchange trader options as well as OTC options that happen as a customized contract between the parties. But the most popular ones are those that are happening to the stock markets. Okay. Now the last one is currency option. Currency option, we know that the underlying asset in that case would be currency. In India, we have said four primary. We have already discussed that in our class. Four currencies we get either paired or single, like INR to US dollar or INR to yen or pound or euro. Four currencies. Either you can have paired like INR to dollar and yen. Likewise, you can have paired. There are different types of options that are available, and the underlying asset definitely would be currency. And the basic objective is hedging against the fluctuation of exchange rate. That's it. These are some of the terminologies. And the primary difference between the future and option is, in case of future, we know that it is obligation. If Mr. A and Mr. B enter into a contract for Mr. A has agreed to purchase 100 shares of HUL at 2,350. Accordingly, Mr. B has agreed for selling it, so it is obligation in both these parties, with respect to both these parties. A is obligatory to B for purchasing that, and B is having an obligation to sell it. So that happens in future. There is no special right for anyone. Both are in a condition of obligation. But with respect to option, it is, the person in the long position is having right. He is not having obligation. He is having right to exercise or not. When A decides that he is going to buy, B has only one obligation: sell it to him. So A has the right, but B has the obligation to act according to the interest of the party in long position. Okay, to act according to the interest of the party in long position. That is actually the obligation of the person in the short position. A person in the long position does not have any obligation. He is having only the right to exercise or not, the decision to take up it or not. So that is the main difference between futures and option. One difference. Then in futures, there is no such thing called premium payment because there is no purchase of right. Of course, there is margin which is kept in the store, in the platform, in the clearing house, and the net off is being settled between the parties. But there is no such case of premium payment because premium is paid for buying the right. Then the next is the risk and reward relationship. See, when I am in a long position, my loss is limited to the premium I pay. Why? If I want, I can exercise. If I do not want, I can exit. In that case, what I'm going to lose is only my premium, which I paid to the next party, to my counterparty at the time of entering into a contract. That's the only thing. But my return expectations are more. It can be unlimited. Sometimes if the market is very bullish and the share price went up like anything, maybe in 3 months it went up with 50% increase. The whole profit remains with me. So that's why we say that there is unlimited possibility of return and there is limited possibility of loss with respect to person in the long position. It's just the opposite for person in the short position. There is unlimited possibility for loss and limited possibility for profit. Now, what is limited possibility? The premium he has got at the time of selling is right to sell or right to buy. So that is actually the risk return relationship between the parties in case of option. That's not the case when it is in future. Both the parties have equal position. If one gains, the other is going to lose. Both of them will be having equal position depending upon the market condition. But here it's not like that. The person with the long position is having limited loss and unlimited possibilities to make profit. In that case, you might think that, okay, then everybody will take up long position. Why should you go with short position? Because at times, when the market is very bearish and you're very sure that the market will move only, if it is for sell, the market will move only in one direction, you will go for selling your right, expecting your profit in the form of premium. And then there are different covered option types and all, but you don't have to go into such details. Covered positions and all. You might go with selling your right here and then somewhere you will go with buying your right. There are. That later we can understand. But now for the time being, you just have to understand this is actually the risk relationship in case of future and for future and options. Okay. So we stop here. After discussing the payoff profile, we will be going with discussion of practical exercise of how do we decide whether you are in at the money, in the money, or out of the money. We will do that. Okay, I'll show diagrammatic representation and we'll do exercise in the evening. So to summarize our today's class, in our today's class, we had started with introduction about the features of option as a derivative instrument and the primary task which you have to understand, the primary feature which distinguishes option from other derivative instrument here is, here the option holder, the person in the long position is having a right, or it can be called as an option to go with exercising the contract or not. He can decide whether he needs to buy it, or maybe if it is the right with respect to sell, he can decide whether he wants to sell or not. Right? The person who has bought who is in long position, who has bought the right, that right can be for buying or selling. That is, which means the person on the other side is having an obligation. This is a primary difference which you can find between. So the person in the long position is having an option to exercise or not. That's why the name came up like that. And how does he get that option? By paying something called as option premium, which depends upon the time period, the volatility in the market, the nature of the asset. There are different factors that the stock market takes into consideration when they decide the option premium. Okay. And then we talked about the different terminologies which we normally come across when we are talking about options. And finally, we also discussed about the concept of in the money, out of the money, at the money. The concept is in the money means when you expect a positive cash flow from your by exercising your option trade. That is, if you're in long position for buying, if it is a call option, and if the spot price, if the future, the spot price on the expiry of the contract of that particular asset is maybe, as you say, is higher than the price promised for you, then you can expect a positive cash flow. It happens in the reverse order if the option, the right is for selling. If the price of the asset is trading at a higher price than you expect a negative flow, then that is called as out of the cash. But if it is lesser than, you're right. That is, if you can sell the asset at 500, but the price at which it is trading is 400 in the day of expiry, then naturally you can expect a positive inflow of 100 rupees, because you are selling an asset which is now having a value of only 400 for rupees 500. So you have a gain of 100 per share. So that is also called as in the money. And then at the money is nothing but when your gain and loss is when you are in your break even. That's what we call as break even. You have no profit, no loss. That condition in option trading is what we call as at the money. You are just at your par. That's it. So these are some of the terminology